I am Reed. I am 27, just an average dude. I've made tons of money mistakes in my 20s, and now I want to share everything I've learned to help you take control of your finances and your life. All right, man, let me tell you something straight up. I was sitting in my apartment last night looking at my portfolio, and I just had to laugh. Not the happy kind of laugh, the kind where you realize you've been an idiot and there's nothing you can do about it except learn from it. I made a dumb move chasing a stock that jumped 10% in one day because some big name investor bought shares, and guess what? I got burned. Not completely ruined, but burned enough that it hurt. I lost about 12 grand in a week. And you know what the worst part is? I knew better. I've been doing this long enough now to know that chasing headlines is a losing game, but I did it anyway because I got greedy. I saw the green candles, I saw the hype, and I told myself this time is different. Spoiler alert, it wasn't different. So let me break down what happened and why I think a lot of you out there are probably making the same mistake I made, because I see it everywhere right now. People are chasing names like Nebius jumping 10% because some guy named Leopold or whatever disclosed a 5.6% stake. And I'm sitting here thinking, does that really make any sense to you? Like, seriously, think about it. One guy buys shares and suddenly the stock is worth 10% more overnight. Does that sound like a healthy market to you? Because to me, it sounds like we've reached a point in this cycle where people are just looking for any reason to buy. And when that happens, you got to be careful. Real careful. I remember back in 2021 when I first started getting into investing seriously. I was fresh out of my broke phase, the phase where you're living paycheck to paycheck and you've got credit card debt piling up and you tell yourself you'll figure it out tomorrow. I had just paid off my debt. I had built up a little emergency fund, maybe 3 months of expenses, and I thought I was ready to start building real wealth. So I started watching all these YouTube channels and reading all these posts about stocks that were going to the moon. And I fell for it, man. I fell for it hard. I bought into some hype names and I watched them go up and I felt like a genius. Then they came crashing down and I felt like an idiot. Sound familiar? Here's the thing about chasing headlines. It works until it doesn't. And when it doesn't work, it hurts because usually you're buying at the top. You're buying when everyone is excited and the smart money is already selling. I learned this the hard way and I keep learning it the hard way because old habits die hard. But the difference now is I catch myself faster. I recognize the pattern and I want to help you recognize it too. So let's talk about what's actually happening in the market right now, because Therese, some interesting stuff going on, and I think Therese, real lessons here for regular people like us who are trying to build wealth without getting wrecked. First up, Snowflake. Snowflake reported earnings and the stock jumped over 30%. Now, I gotta be honest, I was impressed by these numbers. They beat product revenue estimates by almost 5%, they beat earnings estimates by a solid margin, and they raised guidance. But here's what really caught my attention. Snowflake is proving that their consumption-based business model works in the age of AI. And that's a big deal because for a while there, everyone was saying that AI was going to kill these older software companies. But Snowflake is showing the opposite. They're saying AI is making their business stronger and faster. And when you see a company do that, it tells you something about the quality of the business. Now, I don't own Snowflake. I looked at it back when it was trading around 120 bucks and I hesitated. I thought it was going to go lower and look what happened. It doubled. Sometimes you just gotta admit you missed the boat and move on. There's always another opportunity, and that's something I've learned the hard way too. You can't catch every trade, you can't own every stock. If you try, you'll drive yourself crazy and you'll probably lose money. Then we got Salesforce. Salesforce reported too, and the stock barely moved. Flat. Now, why is that? Well, Salesforce is showing some growth in their Agentforce products, but it's still a small part of the business. Their overall growth is solid, but not spectacular. And in this market, if you're not spectacular, you get punished. The stock is trading at like 20 times earnings, which honestly is not expensive for a company of this quality, but the market doesn't care right now. The market wants to see acceleration, it wants to see AI driving real results, and Salesforce is saying, hey, give us time, it'll come, but the market is saying, nah, I want it now. I actually think this could be an opportunity for patient investors, and I consider myself a patient investor now. I used to be impulsive ID, see a stock moving and ID want, and immediately FOMO was real. But I've learned that the best investments are the ones you make when you're calm and thoughtful, not when you're excited and scared. So if you believe Salesforce is on the right track and you have a long time horizon, this might be a name to look at, but do your own research, don't just take my word for it. Now let's talk about Meta, because this is the one I'm most excited about. Meta is my favorite name right now and has been for a while. I think it is ridiculously undervalued. The stock is basically flat over the last 12 months, year to date it's down. And I'm sitting here looking at a company that is generating massive profits, still growing at a solid rate, and investing heavily in AI and the metaverse. And everyone is so focused on the capex that they're missing the bigger picture. Here's what I think a lot of people don't understand about Meta. Yes, they are spending a ton of money on AI infrastructure, billions and billions of dollars. And yes, that capex is scary if you just look at the number. But here's the thing. Meta is already seeing huge improvements in their core business because of these AI investments. Their advertising platform is getting better, user engagement is getting better, and they are starting to roll out subscription products that could generate billions in high-margin revenue. I did a DCF on Meta a few weeks ago, and even with conservative assumptions, I found over 35% upside from current levels. My bull case shows almost 80% upside, and the bear case, which assumes the capex spending doesn't pay off at all, shows only 14% downside. So the risk-reward here is pretty compelling in my opinion. Now, I know some of you are thinking, but Reed, what about the metaverse Reality Labs is losing billions? And yeah, you're right, Reality Labs is losing money right now, but here is what I would say. Look at the history. Meta has been doubted before. When they started investing heavily in Reels, everyone said they were wasting money. When they started buying GPUs before everyone else, people said they were crazy, but those investments paid off, and I think the same thing will happen with their current spending. Also, something interesting happened yesterday. Meta announced they're testing new subscription plans for Instagram, Facebook, and WhatsApp, including an AI-specific plan. Now, this might not seem like a big deal, but think about it. Snapchat has over 25 million paying subscribers, and that's generating over $1 billion a year. If Meta converts just 2.6% of their 3.6 billion monthly active users, that would add over $4 billion in high-margin revenue. If they convert 5%, that could be close to $10 billion. And this is just the beginning. Meta has a massive distribution advantage that most companies can only dream of. They have billions of engaged users, and they're just starting to figure out how to monetize them beyond advertising. To me, this makes total sense, and I think eventually the market will realize it. When that happens, the stock could soar, but you gotta have patience. And patience is hard. I know I struggle with it too. Now let's go back to Nebius for a second, because this is where I made my mistake. Nebius jumped 10% because some fund disclosed a 5.6% stake. And I bought in. I told myself this is different. This guy has a track record. He was early in other AI names. But the more I thought about it, the more I realized I was just making excuses. The stock went up 10% because of one person's buying. That is not a fundamental reason to own a stock. That is noise. And I let the noise distract me. I ended up selling at a loss. Not a huge loss, but enough to remind me why I don't chase headlines. The stock has since gone up a bit more, and part of me is like, man, I should have held. But I know I made the right decision because I was buying for the wrong reasons. If I buy a stock, I want to buy it because I believe in the business, not because someone else is buying it. Here's what I've learned about this market we are in right now. We are in a headline-driven market. Every day, Therese, some news, some rumor, some announcement that sends stocks flying. Drones, quantum computing, nuclear energy, you name it. And that can create opportunities, but it also creates a lot of traps because when the headlines stop flowing, the stocks usually come back down. And if you bought at the top because of the headline, you get stuck holding the bag. I see this happening with drone stocks right now. Therese talk about government contracts and financing agreements, and the stocks are ripping higher. But a lot of these companies are not showing the revenue yet. The excitement is based on what might happen, not what is happening. And that is dangerous territory for regular investors like us. I am not saying don't invest in these areas, but I am saying be careful, do your homework, and don't bet more than you can afford to lose. So what should you do instead of chasing headlines? Well, let me share my approach now. It took me years of mistakes to figure this out, so hopefully you can learn faster than I did. Number one, I focus on businesses. I understand. I am not a tech expert. I am not a finance professional. I am just a regular guy who likes to read and learn. So I stick with companies that have clear business models and track records I can evaluate. No fancy biotech stuff, no crypto mining stocks, no companies that lose money and promise profits in the future. I want to see cash flow. I want to see recurring revenue. I want to see management that is honest and competent. Number two, I buy with a margin of safety. This is something I picked up from reading about value investing. You want to buy stocks at a price that gives you room for error. If your analysis is wrong, you want to still be okay. That means you don't chase stocks that have already gone up 50% in a month. You wait for pullbacks, you build a watch list, and you wait for your price. Number three, I diversify, but not too much. I used to own like 30 different stocks because I thought that was safer. But what I found was I couldn't keep track of all of them. I was just buying names without really understanding them. Now I own maybe 10 to 15 stocks that I know really well. I follow their earnings, I read their filings, I understand their competition, and that has helped me make better decisions. Number four, I keep some cash on hand. This is huge. When you are fully invested all the time, you have no flexibility. When the market drops and opportunities come up, you can't take advantage because you have no money. So I try to keep maybe 10 to 15% of my portfolio in cash. That way I can be opportunistic when the market gives me a gift. Number five, I focus on my own life first. This is the most important one. Your investments are supposed to support your life, not be your life. If you are spending all your time staring at stock charts and worrying about every move, you are doing it wrong. Build your career, learn new skills, spend time with people you love, take care of your health. Those things matter way more than whether your portfolio goes up or down 2% in a day. I know this sounds simple, and it is, but simple doesn't mean easy. I still struggle with it. I still get tempted by the hype. I still make mistakes, but I am getting better. And that's all any of us can do. Just get a little bit better every day. So here's my advice for you if you are watching this and you're in your 20s like me. Start investing early, even if it's small amounts. Don't try to get rich quick because that usually ends badly. Focus on building good habits. Pay yourself first every month. Automate your savings. Invest in low-cost index funds if you don't want to pick individual stocks, and if you do pick stocks, be prepared to hold them for years, not weeks. Most importantly, do not let the market stress you out. The market will always have ups and downs. That is normal. What matters is that you stay disciplined and stick to your plan. If you do that, you will be fine in the long run. All right, man, I think I've rambled enough. I hope this was helpful. I know I made some mistakes recently, and I wanted to share them honestly because I think that's how we all learn, by talking about what went wrong, not just what went right. If you have questions or if you want me to talk about something specific, drop a comment and let me know. I'll try to get to as many as I can. And remember, building wealth is a marathon, not a sprint. Take your time, be patient, and don't chase the hype piece.